Warren Buffett has been a better investor than you or I ever will be his entire life.
Warren Buffett, one of the most successful investors of our era. Did you know that he used to sell chewing gum and magazines door to door back in his childhood? But today, he has a net worth of over $132 billion. Buffett's story isn't just inspirational, it's a masterclass in smart investing. One that could take you from zero to, well, who knows how many zeros by 2024. And that's exactly what we're diving into today. How can Warren Buffett's principles of investment turn your financial game around, even if you're starting with nothing in your pocket? In this video, I'll tell you how to get rich in 2024 with Warren Buffett's investment strategies if you're starting from $0. Think of this video as your golden ticket. We're diving into the 5 golden Buffett-approved rules of investment to make your money work for you, turning those zeros into something a lot more exciting in the coming years. Before we roll up our sleeves and dive in, hit that subscribe button and ring the bell. That way, you won't miss out on any of our tips and tricks for smart investment. All right, ready to see how you can start your journey to getting rich Buffett style? Let's get started. Rule number 1, start early.
Well, I was lucky that I got started early. I mean, it always helps if you get started early. And my dad happened to be in the investment business, so I would go down to his office on Saturdays. And so at age probably 7 or something, I started reading these books that were around the place. And so I had a 15-year jump on many people in a sense, and that helped a lot. And I was always fascinated by it. I mean, I knew what I wanted to do early, and I think that's a huge advantage too. And then you don't need a lot of brains in this business. I mean, I've always said if you got an IQ of 160, give away 30 points to somebody else because you don't need it in investments. What you do need is emotional stability.
The first golden rule is as simple as it gets. Start early. You see, Buffett compares building wealth to rolling a snowball down a hill. The earlier you start, the longer the hill you have ahead of you, and the bigger that snowball gets by the time it reaches the bottom.
I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. 3 shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today. Oh man.
Buffett himself kicked things off pretty early, and look where that got him. Now, he's not saying we all need to be business tycoons by our teenage years, but the principle stands. The sooner you begin, the more time your investments have to grow. It's all about giving your money the maximum amount of time to work its magic through compounding. That's where your money earns money, and then that money earns more money, and so on. It's like a snowball effect on your bank account. So, how does this help you make money? Well, starting early gives your investments a chance to ride out the ups and downs of the market. It's not just about throwing your money into the stock market and hoping for the best. It's about consistent, long-term growth. The longer your money is invested, the more potential it has to grow, thanks to the compound interest. Rule number 2. Never invest in a business you can't understand.
Most good businesses, you can understand what they're about in a very few minutes, unless they're a kind of business that you never can understand what they're about. I mean, there are other businesses, if you spent years on them, you still wouldn't understand what the hell's going on. I don't know which American auto company is going to do the best 10 years from now. And if I spent all year talking to dealers for Ford and Chrysler and General Motors, and I talked to suppliers, and I talked to people who are driving their cars, I still wouldn't know anything about what it's going to look like 5 or 10 years from now.
Diving into Warren Buffett's second golden nugget of investment wisdom, we hit a rule that's as clear as day but often overlooked. Never invest in a business you can't understand. So, what's this rule all about? To make it simple, if you're scratching your head trying to figure out how a company makes its money or what its business model is, it's probably not the investment for you. This isn't about shying away from industries that are new to you. It's about the importance of doing your homework and really getting to grips with what a company does before you decide to invest your hard-earned cash. Why is this so crucial? Because understanding a business inside and out gives you a better understanding of its potential for success and, importantly, the risks involved. Let's break it down a bit. Imagine you're considering investing in two companies. One manufactures a product you use daily, and the other is a tech startup working on quantum computing solutions. If you're not a tech expert, the first company might be a safer bet because you understand the product, the market demand, and how the business makes money. However, investing in a tech startup could be riskier because the business model and technology might go over your head. Rule number 3, invest for long term.
Basically, I don't want to buy any stock where if they close the New York Stock Exchange tomorrow for 5 years, I won't be happy owning it.
Warren Buffett's third golden rule of investment is all about playing the long game. Invest for the long term. This piece of wisdom is not just advice, but a mindset shift. Buffett himself uses the analogy of buying a farm to illustrate this principle beautifully. You wouldn't buy a piece of agricultural land fretting over next year's weather, would you? Instead, you'd buy it with a vision for its potential over the next decade or two. This same philosophy applies to investing in the stock market or any other form of investment. So, why is long-term investing such a big deal?
I'm not recommending that people buy stocks today or tomorrow or next week or next month, but you shouldn't buy stocks unless you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them. And you're not going to pick the bottom and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more.
For starters, it steers you clear of the market's day-to-day volatility. The stock market is like the ocean. It has its calm days and its stormy days. By committing to a long-term investment strategy, you're essentially saying you're prepared to ride out those storms because you believe in the long-term potential of your investments. Investing with a long-term perspective also means you're giving your investments the time they need to grow, leveraging the power of compounding interest. This is where things get really interesting. The longer your money is invested, the more time it has to generate earnings on your earnings, creating a snowball effect that can significantly boost your wealth over time. Rule number 4, do not spend money on things you don't need.
Let's ask who is the more frugal between us. Charlie, who do you think is...
Well, in personal consumption, Warren is more frugal.
Buffett famously said, "If you buy things you do not need, soon you will have to sell things you need." This isn't just a piece of advice. It's a lifestyle choice that one of the world's wealthiest individuals lives by. So, how does practicing frugality help you make money? It's pretty straightforward. Every dollar you don't spend on non-essential items is a dollar you can invest. And in the world of compounding returns, every dollar invested today could potentially grow significantly over the years. Frugality helps you build a stronger financial foundation for investment. Buffett himself embodies this principle in a way that might surprise many. Despite his immense wealth, he's known for his modest lifestyle. He still lives in the same house in Omaha, Nebraska that he bought back in the 1950s for $31,500. He doesn't spend money on luxury cars, yachts, or expensive gadgets. This isn't about being stingy. It's about recognizing what truly brings value to your life. Rule number 5, earn now, save for later. Warren Buffett advises, do not save what is left after spending, but spend what is left after saving. This reversal of the usual spend-first mentality is a cornerstone of Buffett's financial wisdom and a critical strategy for anyone aiming to build wealth. So, how does this principle help you make money? At its core, it's about prioritizing your future over your short-lived desires. By setting aside savings before you start spending, you make sure that you're consistently funding your future wealth, rather than just hoping there'll be something left over at the end of the month. Implementing this rule could mean automatically diverting a portion of your paycheck into a savings or investment account before you even have the chance to spend it. This pay-yourself-first approach guarantees that you're building your financial security with every paycheck rather than leaving it to chance. By adopting the earn now, save later rule, you not only build a bright future but also compound your ability to invest. The money saved becomes capital that can be used to generate more wealth through investments. Over time, this disciplined saving and investing can lead to significant financial growth, turning the dream of financial freedom into a tangible reality. With these 5 golden rules of investment, you can now start taking the first big step you've been hesitating to take. And if you need more tips on how to build wealth from nothing, don't forget to watch our next video. Let us know in the comments section below which one of these rules you are already following and what is missing. We will be back with another video soon.